Volatile day in the market. S&P rallied really hard on the PPI numbers, which we're going to go over here in a minute. We love to see these rallies. It's very exciting. Got right to a resistance level. That 4180 seems to be our nemesis. What's nice is we're getting really very clear on where that bottom is. That bottom's becoming that 4100. The question is, what's going to take to get us out of this range? We're going to address that. A lot of people thought it was going to be PPI. I think it's going to be something different, which I will address. So you can see right in here how we just closed right at that level again, going into banking earnings tomorrow, which we're going to need to go over. Major support has held on the XLF, which is the financial sector of the S&P. Drilling into that on a weekly to a 15-minute chart, you can see our levels pretty clearly right in here and how we've been battling them, and it looks like we're finally starting to close over them. We need to focus on what is margin debt percentage growth. Why are we at the lowest level at 20 years, and why is this bullish? Dumb money crosses smart money for the third time in 6 months. We're going to go over what usually happens when we see this. Why Guard Force has gone from $2 to $35 in 7 days, and what are the next names that are poised to have a similar move, or a possibility, I should say, of a similar move. Let's get into it. Welcome back, everybody. So in today's video, we're going to start with the indexes. We have a lot to go over. Thank you for your comments. We're going to start with the futures market. That's where the most comments were. What you're most interested in seeing, comment below, because that's why I create the content. Now, take a look at our level right here. This is not rocket science. We are constantly bumping our heads right here over and over again. Now, I'm just going to say something. I'm a big believer in probabilities, and it's one of the reasons how I trade. And the one thing that I would say about that is a quadruple top. If let's say we rule this out and we call this a quadruple top, call this an anomaly. Getting here 4 times and not breaking is highly unusual. I would say that the chances of this not breaking historically are probably around 20 to 25%, but don't quote me on that. You can actually back test that on any system. But when you get up to these levels, it's pretty clear. As long as we're hitting these higher lows, as we went over pre-market today, there's very little reason to assume that that's not going to be the case. So I would pay attention to this. I think it's a great way to just kind of hone in what is exactly going in. We're seeing a lot of people that all of a sudden have become economists, and our job is to trade. If the market wants to go up, we want to participate. If the market wants to come down, we want to participate. I don't need to explain to the market that it's wrong if it wants to do this, and I certainly am not going to explain to the market that people don't understand if it does this. It's the quickest way to the poorhouse. Now, S&P was up 1.25% today. What was perfect about this was that the Nasdaq in and of itself was up more. And that's exactly what we want to see, right? We always want to see the Nasdaq up more than the S&P. We're going to go over that chart in a moment. And we can see our lines right here very clearly. So we talk about a neckline and we talk about bumping on that neckline. And you can see right here, 1, 2, 3, pushes through, comes back, retests, and rips. That doesn't get any clearer. Now you can see your levels right in here very clearly, and you can see how we just came back down. But there's another pattern in here that's very, very obvious. And we're going to just stick with the basics today. There is some data that I definitely want to go over, but I think people are just missing the obvious. So if you take this point right here, we just kind of drill this down here and come across. Let me just pull this over so you can see it in great detail, and just drop us down here and slide that over just a little bit. We have a cup there, don't we? So we have a cup, and then you would want to look at where the top of that cup is, which is right there. And if we came over here and we just did something as simplistic as look for a handle, we have a handle right here. Now that's not drawn the best, but it is what it is, and we're going to have to work with it. You always clone them because you want the same trajectory of the lines. That's why there's the functionality of the clone. And we just kind of go to here, and let's get rid of the indicator for a second. Look how pretty that is. That could be in a textbook, guys. So you have a cup and handle, and you're setting up to break out. So I really don't care what people are talking about with the PPI and deceleration. We're going to address it. But this is what you need to trade. You need to trade what is happening. And if you trade what is happening instead of arguing about whether or not it's supposed to happen, your P&L will thank you. Now, before we dive into the numbers, I just want to walk everybody through something. So this is Meta, and this was a trade that we did. Came back down, we waited, got another setup, we did it again. and we did it again. And we did it until it finally got us up and into a point where we cannot lose money on the trade, barring gap down or some kind of news. And so what we were trying to do with the swing trade was get up and in and stay in. Now, why the Nasdaq is developing, why people are debating, are we going through deflation from inflation? Is all this happening so fast? Yes. Does not matter. Are earnings going to come down? Yes, to a level we haven't seen since 2020. Nobody cares. Meta's up $6.50 while people are debating this, okay? This is what you need to focus on. When everybody was selling Microsoft yesterday, we were looking for spots to step in and buy. Watched it retest this level again. I'll show you. We watched Microsoft retest that level again, and then when it retested it, it became really clear where our support line was. Again and again and again, and then we couldn't get there anymore. And once you can't get there again, that's what you want to see. So when you know where that support line is, you're not the only one that knows where that is, right? I mean, that makes a lot of sense. We're not the only people that are able to draw support lines. Anybody can do this. It's not a question of you can do this. It's a question of can you apply the knowledge that you're learning in an efficient manner. So you have these levels right here, and then you notice that this one can no longer get to that level. And then all we had to do was just give ourselves a really simple trigger, and that was pretty easy to see. So here's your long red nasty bar. And then once you have this set up encapsulating here, that's actually a pattern that I follow. And then we just put the trade on. Now, this trade that we put on wasn't here. And I want to point this out. It was somewhere else. It was the day before when nobody wanted to buy this. And that's the point that I'm getting at. That same level, again, because I know where that level is, I can watch that level right here trigger again. But once you know where your levels are, you want to leave them in. If you see an executable level like we had here, you want to leave them in and see where it is, because that can lead to another opportunity to get in. You might want to remember that and rewatch what I said there a couple times. But that's a really important thing. Now look at what you have. You have this W, you have two entries that worked perfectly. You have a stock that is absolutely gap filling, that has people wondering what they're going to do and how they're going to, quote, get in, and do they want to buy now? Now, the one question I always get in the comments is, did we miss those names? And I'm going to be blunt. I don't think that you have. Are you going to see pullbacks? Absolutely. But take a look at the Nasdaq today, and we're going to drill into it a little bit more. Core PPI, pardon me, 0.3, we come in at -1. Initial jobless claims, 239 versus 232. Now, the 4-week average is down, but we knew that was coming because we had some sub 200 numbers here, didn't we? PPI year over year, 2.7 versus 3. And this just took home the winning prize, -0.5. And we were looking for 0.1, and we were looking at 0. This led to some real selling today. This scared a lot of people. And the reason that it scared a lot of people was because it was so low. We've only seen this over 2.5 years ago. The blue arrow is pointing at the 0 line. And I just want to point, this is today and where we are. And the last time we were lower than this was something called the pandemic, which is it's almost been 3 years, hasn't it? And that's where we're at. And that's why we saw a little bit of panic today, didn't we? And that panic stemmed from the fact that people were saying, wow, this is going to be worse than we think. Things are going to implode, blah, blah, blah. I don't know that I want to buy. I want to be really clear about this with my blah, 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 and what I mean by that. Not that you should not be paying attention to this. You absolutely should. But you need to weight it accordingly and understand where you are in the pecking order. Now, let me explain what I mean by that. So we're going to look at the Nasdaq on the futures market in a 15-minute, and we can relate this to the Qs. But you can see our level right here. We can see how we try to get through that level, right? So with all this news coming out, all this debate going on, the bottom line is 13 is still 13 and is still support, no matter what. We tested here, we've tested here, we've tested again. It is support, period. It does not matter if we're going through inflation, deflation, reinflation, stagflation, does not matter. So here you are again, 13.2, trying to get over. Now, are we going to get over and stay over? Nobody has any idea, candidly. We all think that we do, but I don't know what the banking stocks are going to say tomorrow. And we're going to obviously have to cover that tonight because that's going to be critical. If you take a look, it is absolutely unequivocal that you are in a trading range. And until you come out of that range and support is up here, right, after it flips resistance, or this gets another test, we just don't know yet. but we just have to understand where we are and pay attention to it so that if we know we're here and we know that this is a key level, if we were to do something along the lines of come down being at this level, right? And then we were to reverse and go back over. Well, now we know that this is most likely going to have a test of support and that it's probably going to hold. And then that lets us know that this line right in here is probably going to be what? That's going to be basically our stop on that bet that this is going to break out. So that's what we want to watch, and that's why these key levels are important. Now, before I dive into why we have to worry about the pecking order and where it becomes important, I really want to just focus on this. So this is smart money versus dumb money. As everyone's aware, we do not call it that. We call this institutionals versus retail traders. And the purpose of that is because I don't view that what retail is doing is dumb, and I don't view as what institutions do all the time is smart. So it just lets us know where the players are. So if we take a level here and we go, well, up here in the blue, they were completely peaked out on their investments. And back here in May and June, we were not peaked out and not selling. We were buying, right? So let's just, we'll mark it here and then we'll mark it here as well, okay? So we came in, we were buyers, retail, refer to myself as retail, and then we come down here, institutions were selling. All right, so then if we take a look at these peaks and look at that peak right there, I wonder who sold into that peak. Well, retail sold to who? Institutions. Institutions bought and maxed out. Where did they max out at? Well, they maxed out right here. How'd that go, right? Where we're at the bottom. Who bought at the bottom? Retail bought at the bottom. Who got out of their positions at the bottom? Institutions. So here we have a cross. Here we have another cross. What happens when we get these crosses on the S&P? Well, it's pretty obvious what's happening. Every time that you're seeing retail get involved from these trough levels, you're seeing the same trade over and over again. Clean this off and we'll start all over again so you can see it. So when you have this right here where you're starting to see retail and the cross is right there, right? And you just kind of come here and look at that. You can say, well, this is the trough level and this is where we crossed. This is where we crossed. This is the trough level and this is where we got to. And you just kind of mark those off. And what are you seeing? Well, you're seeing a pattern. Not really sure why that broke there, but we're going to just roll with it. So now you can see to the downside, when retail gets out, what happens to the market? Well, when retail is getting out of the market, what's happening? Market is collapsing, right? And we can see that. So what happens again when we cross? Well, we've seen what happens here. We've seen what happens here. So it is a decent assumption to assume that we might see something similar. Is there a guarantee? No. If you want a guarantee, as my father used to say, buy a toaster. So you can see these lines right here, and you can see how we are seeing institutions completely sell, and retail is stepping in and saying, thank you very much. Now that leads us to our next talk about what we're going to do with the pecking order. What does he mean when he says pecking order? Why is something important and have different weighting at different times? Well, when we were up here at these peaks, we heard that, oh, well, maybe there'll be some inflation. We might have to stop buying bonds. We're going to have to raise rates. Okay, this is what we heard up here. So this little circle or nightmare up here became what the Fed decided that they were going to do. And when the Fed stopped adding to their balance sheet, that caused the market to come down. Once this happened, this increased the rate of sensitivity of economic data to the market. Once this happened, it increased the rate of economic sensitivity to the market. I said that twice on purpose. So comes down, tries to rally past that level, not rocket science, can't. Things are worse than we think they are. He's on a mission to raise rates higher than any human in history for some reason, and here off we go. And so we just see the bounces, the bounces, the bounces. When does this tide start to turn? Turns right here. What is that date? That is the sign that CPI has peaked. If you go back and look at your CPI data, that happened right there. If you want to see something really interesting from the date of that peak, you measure the volatility of these moves. They have been muted ever since that day. Why? Because as information is important, it's not as important as what it states. It states the obvious. We're at the tail end of this. We can all sit here and contemplate and debate what's going on. We can all say, oh, well, it's going to be another 50 right here, or another 25. To be completely blunt, who cares at this point? The bottom line is, this is where it began. This is where it's ending. This is where our inflection point is. So why this data is important, why we can argue about deflation or inflation, and the market is telling you what's going to happen, by the way. It doesn't matter. Your job as a trader, unless you want to be an economist, is to focus on what's going on. And what's going on is the market's pushing higher. Look at the dollar and what the dollar is doing, guys. Just take a look at the dollar. There was one equation that I gave everybody, and before I forget, make sure that you get the newsletter. There's a link in description. They came out with Substack notes. To me, quite frankly, it is better than Twitter. I think I can curate data a lot faster to people. It's a lot more streamlined. There will be a link in the description to get the newsletter. The newsletter's on Substack, and you'll automatically get notes because of that. It's like an app for your phone. It's free. But I can see myself using that app. It's a lot easier for me to use during the day, during the trading day. So it's something that if you're interested in following along during the day, I would make sure you subscribe to this channel, the Twitter, obviously, but Substack, there's something going on there. And I think that's going to be something that everybody's going to want to pay attention to. Now, if you look at the levels here in the dollar, and all I kept hearing was the dollar is going to break out. And the one piece again that I always try to hammer home is the same lessons over and over again, because it's the repetition that gets us to remember things, right? I mean, that just makes sense. It's how I learned anyway. Maybe I'm just slow, but I need the repetition. So here's our cross, right? So here's our death cross. So here we have, hold on one second. That's right. Okay. So there's our 55 and our 200, and that gives me my death cross. I use a 55, not a 50. And I was stating when we were breaking out here that we're not going to break the 200. We got up to the top. Guess what? We didn't break the 200. And now you have an H. As the dollar drops, they buy bonds. Okay. As they buy bonds, you see what's going on here with the 10-year? As they buy bonds, equities rise. Okay. It is that simple. If you just remember those three things and go, what is the dollar doing? The dollar is dropping. Okay. So if the dollar drops, okay, and the yield on bonds drops so that they're buying it, then equity prices should go higher. Okay. I can do a whole video on why this is. But if you just remember these three things, it will save you a lot of aggravation, okay? And it solves all the economist questions. All you have to do is look at what the dollar's doing and go from there. Is it more complicated than that? Yes. But this is a back of the envelope way to do this that will save you a lot of time and a lot of aggravation. Now, we've been going over this graph, and there's a reason for it. This shows New York Stock Exchange margin debt percent of market cap. This is showing New York margin debt percent of market cap. Margin debt as a percent of market cap is at a 5-year low, right? This is pretty clear to see that. We're at a 10-year low. We're at a 15-year low. You'd have to go all the way back to 2004, right when we turned in the market, right when we were in the Iraq War, to get to a level where New York Stock Exchange margin debt on a percentage of market cap was this low. Okay. What does this mean? Think about it from this perspective. Why would this matter, right? And I'll save everybody a lot of time. If you own a stock in the New York Stock Exchange, you can margin it, right? So the market cap would then determine the amount of money that is out there for you to be able to margin, right? Just kind of makes sense, but it's a little more complicated by that. But if you have 1,000 shares of Microsoft and that's in the New York Stock Exchange, you can margin it. The higher Microsoft goes, the more margin you could use, right? Just makes sense. So if we look at this on a percentage of market cap, that's how much powder is on the sidelines on margin debt right now. 2004 levels. That's where we're at. 2003, 2004 levels is where we're at. And if we remember what that was, 2003, 2004, looks something very similar to where we are, right? So you go 2003, and then we can all see the line down here where we tested over and over again and we held 3 times. Then you can see the break right over here, straight across, okay? So you have your level, and then our circle on where we were at the same level of debt is right here. We can all see that, right? And see how that played out. We can see that what happened when they started to increase the margin debt. And we can see very clearly here on the graph again how the margin debt rocked and rallied the market because they put money to work. So if we now look at the S&P and just say, does it look anything like what we just saw in 2003? Well, you'd have to say 1, 2, 3, 4. Is it exact? Well, no, it's not exact. Nothing usually is, right? We're pretty familiar with that. See the undercut, the test, and now we're here. But you are setting up again to push higher. How long do you think it's going to be if this market starts to rally and the Nasdaq starts to rally before people start using margin debt again? You have a lot of powder on the sidelines, guys. I went over it in yesterday's video. I would watch yesterday's video at least between the 9-minute mark to the 15-minute mark and what was covered in there. It's very important. Citigroup, we have earnings coming out, and that is definitely something that we have to watch. Let's just drop these in so that you can see them. When they come out with earnings tomorrow morning, this is going to have a drastic effect on the XLF. You're also going to see JP Morgan, and then we go into next week, and we also have BlackRock. You're going to want to watch these three tomorrow. You're going to want to watch Citigroup, you're going to want to watch JP Morgan, and you're going to want to see how they act on this news, right? How are they going to act on earnings? What are they going to say? More importantly, I'm curious what they say about the loan loss reserves that they're going to put out there on the market. I think everybody's going to look at that because they're going to want to look at tightening lending standards. My biggest concern is that I'm just not able to rally through, but this is where we crossed, and this is where we have a golden cross. And since that golden cross, what has happened? We are holding that 200, and we will continue to hold that 200 as long as you have a golden cross here, right? It's not rocket science, guys. It's repeatable patterns over and over again. So I would watch Citigroup. Also, BlackRock just raised money, and they raised about $30 billion for a new commercial real estate fund. I would imagine they're going to get a lot of questions about that tomorrow and where they're looking at allocating that money. If you have time to listen to that conference call, I'll give you a quick tip here. Listen to that conference call and try to hear where they're going to put money. If you could figure out where they're going to put money, then you could have an advantage. Are they going to go to Vegas and put it in something like Avicii? Are they looking at just investing in New York real estate because it's so depressed? We just don't know, but you're going to want to hear what they have to say. I'm going to want to hear what they have to say because I want to know how they're going to allocate capital at BlackRock. It's going to be very important. Now, these names were a lot of fun. They've been a lot of fun for the past couple of days. GFAI, you can see how this went from 2 to 36 today. We had people that were trading these things all day long in the community. And the purpose of me pointing this out is the following, and I took that symbol off. Not really sure where that went. Let's drop that back in. There we go. So the purpose of me showing you this is that, yep, I can say it too. Yes, I see the value in the move. You think this is going to go up and it's not going to pull this again? I'm going to just state the obvious. I don't think that that's what's going to happen. I think they're going to go on to the next one, right? So this was another one that we were trading today. It was pretty obvious, setting up the same pattern. You can see the reversal starting the previous day. I did not buy the previous day. I bought today. And you can see how the market's doing and how you're ripping straight up, right? And there's just a bunch of them. Just Google anything that says AI in it, look for a small float and set up your patterns and your recognition. And that's really all you need because now they're into the speculative names. AI itself is no longer speculative enough. Now we're pushing into the more speculative names. And I still think there might be a little bit of room in there. But again, you need to focus on a couple things. Number one, focus on what is going on in the market. You're currently seeing names break out as we just went over. But number two, if they're not breaking out, excuse the lightning back there. We're having a huge rainstorm here right now. I don't know if you can hear it on the mic or not. I'm not going to have time to go back and re-listen to this today. So you can see right in here, right? And you see your level. Look at this hourly chart. So here we are, right? Now look at this. You're flipping. Now the question is, do you flip this DTL tomorrow or do you not flip this DTL tomorrow? But that would definitely be one stock that if I was you, I would want to watch tomorrow and see how it acts. I hope this was helpful. I'm going to link that video right here that I just mentioned that you want to watch from yesterday and just watch from 9 minutes to 15 minutes. Have a good night, everybody.